Hello and welcome to this webinar on property and unauthorised payments in the pandemic. My name's Lisa Webster, Senior Technical Consultant at AJ Bell. Today's webinar subject matter has come about as a result of a number of queries we've received in relation to property held in pensions and the potential for unauthorised payments arising when there is non-payment of rent due to businesses struggling in the pandemic. This is particularly an issue with connected party transactions, which are common when it comes to property held in pensions. Unauthorised payments could also be a potential issue for SAS, where there are issues repaying loans made to the sponsoring employer. So I'm going to start by looking at the basics of property purchase in pensions. I'm sure that this will be a recap for a lot of you, but I'll have a look at the what, the why and how to get property into a pension. I'll then look at what we mean by connected parties, what special considerations there are for transactions between pensions and connected parties. Next up will be how the pandemic has impacted property and connected party transactions and what HMRC guidance we've had out in relation to these matters. And then I'll look at what happens when unauthorised payments do arise, the sort of circumstances around that and the consequences. And I'll finish off with just having a look at some of the other sticking points that might be arising at the moment with regards to holding property, and also some other issues which are more specific to SAS in connection with unauthorised payments that might arise in SAS schemes as well. So starting with the basics then, property and pensions. So before SIPs became as mainstream as they are today, property purchase was often the reason for setting up a SIP or a SAS, opposed to using a more standard personal pension or insured pension. And it's long been a widely accepted asset in the SIP market. And there's plenty of good reasons to put a property into a pension scheme. For example, if you have a business that already owns its own premises, then using pension funds that have already been built up in directors' pensions funds, using those funds to purchase the property frees up cash for the business. And it's quite common for directors, senior managers or whoever in the business to come together with a group SIP or a SAS to pool their funds in order to be able to do it. Once the property is within the pension scheme, then rent from the company will be going into the pension, so that's effectively building up the directors' pension funds, members' pension funds, and from the business's point of view, it's tax deductible expense. So it's another way of the company putting money into pensions for those members, who say usually directors, and it doesn't count towards the annual allowance for those that have annual allowance issues. And it doesn't bust any protection that might be held. So, if you've got directors that have got enhanced protection or a fixed protection in place, so if they make contributions, that busts that protection. Obviously, if it's an investment return, if the pension schemes hold a property and it's rent going in, you don't have any issues in that respect. Once a property is within the pension, then it can grow free of capital gains tax as well. Also, it can be useful for businesses that don't currently own their own premises, so they're operating out of rented properties, and so they're paying rent to an unconnected landlord. Obviously, that's an expense for them. But if they use pension funds to purchase a property, so the pension funds may give them the ability to do that, which the business may not have access to, that amount of cash to be able to do it. And then going forward, it means those businesses are then paying rent going into the benefit of the directors in their pension schemes rather than going to somebody who's unconnected. And of course, pensions can also be used to buy property purely as an investment and have unconnected tenants in it as well. All of these are possible. Of course, there are drawbacks to holding property in pensions as well. The most obvious one is probably how illiquid it is, and obviously it's important to have an appropriate exit strategy in as well as to how we get it out, how people access their benefits. Well, what happens if a member dies, and we need to pay out death benefits, the beneficiary want to hold the property, things like that obviously need to be thought about before a property first goes into a pension scheme. It is only commercial property that a pension can purchase. I'm sure some of you remember prior to A-Day, when we had that period of time when it looked like residential property was going to be allowed in pensions before Gordon Brown's infamous U-turn, a few months before the rules were coming into place. I mean, technically speaking, residential property is still within the rules because, there isn't a permitted investment list. Technically, you can invest in anything in a pension. However, the tax consequences of doing so are such that nobody in their right mind will do it. And certainly no fit and proper provider is knowingly going to let you put residential property into a pension scheme. So most commonly what we see going in are things like offices, retail units, industrial units. You can have agricultural land is also allowed. There are certain job-related residential elements of commercial property which are allowed within the rules, but you do have to be very careful with these. It needs to be linked to contracts of employment. It's quite sort of particular circumstances. There's other awkward properties which we quite often get asked about. Things like care homes. Care homes it isn't taxable property. It's not classed as residential property in that sense as a normal residential property would be. Care homes are allowed under the rules, but there are still issues there. If a pension scheme owns a care home and the management company who's running it and providing services to the residents, looking after the residents, if they go bust, because in the pension scheme as the landlord is left with a lot of old people to look after, which obviously is somewhat problematic. Another one, the frequent one we get asked about is pubs. Clearly it's commercial property. Sometimes there are issues with the residential element with flats above it and things like that, but even putting that to one side, one of the main issues with pubs is that usually when you purchase a pub, it is in connection with a brewery and there's contracts, agreements that have to be in place with the brewery in terms of purchasing beer from them, that particular brewery and them alone, and unfortunately pension schemes aren't allowed to buy beer, so that can rule out pubs in a lot of circumstances. So there's a few things that have to be a little bit careful of. When it comes to purchasing property, it is possible for a pension scheme to borrow to help fund the property purchase. Technically, a pension scheme can borrow for any purpose, but a lot of schemes will restrict it only for property purchase, and that's certainly the case with Investcentre. And you can borrow, the pension scheme is allowed to borrow 50% of the scheme assets as a maximum. So as an example here, if there's cash and investments in the pension of £400,000, so that is the net asset value, your maximum borrowing will be 50% of that, which is £200,000. So you have £600,000, assuming all your investments are cashed in, £600,000, which is available to purchase the property. It is important to note that that has to include any VAT that's applicable. Obviously, new builds will normally have VAT, and depending on work and things that have been done on the property previously, VAT may be applicable. You can't get separate VAT loans anymore. It's all got to be part of the 50%. It has to cover your stamp duty, it has to cover all your fees, so like, legal fees, surveyor's fees, obviously your SIP fees, everything has to come within that funds that are available. Again, pension rules, technically speaking, you can borrow from any lender, but Investcentre and like a lot of providers will only allow borrowing from a commercial lender, and that lender will obviously want to take security. Pension scheme rules do allow security to be taken over any assets within the pension fund, but we do only allow it has to be over the property, not any other assets that are held in there. So as an example then, we've got this fund here which had 400,000 net asset value, can borrow up to 200,000. In this example, they didn't take out the maximum borrowing, they borrowed £175,000 and they bought property which for £450,000, but obviously they needed the additional funds because they had to pay the SDLT, there was VAT, there was fees, for that purchase to go through. Following on from that, 3 years later, if they came back and they wanted to purchase another property, which we do see happening from time to time. We look at what they've got 3 years' time, their existing property that they already purchased, that is now valued at 475,000. They have got some other investments and cash within the pension fund. There'll have been rent coming in for the 3-year period since they purchased the property. There may also have been contributions coming in, maybe even transfers, whatever, coming in from elsewhere. They have existing borrowing of £100,000. So if they borrowed 175,000, paid quite a bit of it off already. It may be that some of it was just for the VAT element, and therefore they could pay that off quite quickly when that was reclaimed. So the fund now, the net asset value of the pension scheme is now 525,000. You then need to do the borrowing calculation again. The borrowing calculations this 50% limit is at the point that the borrowing is made. It's not an ongoing test. So, if the property value falls subsequently, it doesn't present you with an issue immediately or anything like that. So the maximum borrowing then at this point of time would be £262,500. But it's important to remember that you do already have the £100,000 loan. So the actual further borrowing that you can have is only 162,500, because that 262,500 is the overall borrowing that the scheme can have at any point in time. So here you have the £150,000 cash if you're cashing the existing investments plus the new loan that you can take out. So you'd have 312,500 available for a second property purchase, and again that would need to include all the fees, stamp duty, etc. on that. So yes, borrowing is possible to help with property purchase in pensions, but it is quite limited. So that means that pensions are never going to be heavily geared when it comes to property purchase or anything else really. So moving on to connected party transactions then. So it's really important that connected party transactions take part on a commercial arm's length basis, because if they don't, this is when we can have unauthorised payments arising. So we will always need to get evidence of commerciality. So when we're talking about property, that means that there has to be a red book valuation from RICS. Ask a RICS surveyor, he will know what a red book valuation is. It's obviously their rule book of the sort of the conditions that they have to meet for performing valuations. So when there's a connected party transaction, we need a red book valuation, and whatever the value of the property is, that's the purchase price that will need to be in place for the pension scheme. It's not like when you're buying off an unconnected third party where you can have a bit of negotiations, and normally people, properties go on the market, somebody will make an offer, there'll be some negotiation. It will just be, it has to be whatever the RICS report says for connected party transactions. In the report as well, it won't just be the purchase price, it will also have the rental value in there, the lease, the rental value in it. And again, there isn't any leeway with connected party transactions. You have to pay whatever the RICS surveyor says is the going rate for it. So what do I mean by connected party transactions? Who is a connected party? So most obviously you think of family members. So if you have the pension scheme member, so obviously it's a connected party transaction if they're purchasing the pension scheme, their pension is purchasing a property that they already own themselves, they're clearly connected, but also family members means spouse, civil partners of the individual, the member, any relative of the individual and their spouse, and so on. What it means by relative in terms of the rules is defined as being a brother, sister, ancestor or linear descendant. So yeah, parents, grandparents, children, grandchildren, etc. But technically speaking, it's not nieces, nephews, cousins, aunts, uncles. It may be the reality that feels like there is a bit of a connection or whatever, but in terms of the rules, technically speaking, they are not connected parties. But I suppose more commonly with a lot of these transactions, we are talking about a connection between a member and a business. So a lot of it is company directors or partners in a business that say that the member of the pension scheme is their business that they're transacting with. So a company is defined as connected with a SIP member if that person has control of it. And a control can be defined in a number of ways. First of all, if you have 50% or more of the shares, you're instantly deemed to have control. Controlling directors, so somebody who is a director and they own 20% of the shares. But also, it is important that we would normally have to look at the powers, look at the Articles of Association and the powers in there. So it's possible for people that don't meet either of the first two bullets. They may be a director but only own 15% of the shares, but because of the powers in the Articles of Association, their position or whatever, they may still be deemed to have control. It's not a straightforward, just a measurement in terms of how many shares they hold. It is a little bit more complicated than that. And also control can be alone or with a connected person. So if a husband and wife own 30% of the shares each, between them they own 60% of the shares, therefore they would be deemed to have control. Or there might be husband and wife that are both directors that own 15% of the shares each, they would be deemed to have control because between them they're both directors and they would have 30% of the shares. So it will vary a bit on the circumstances, and normally, we need to look at this sort of quite closely to see if it's not clear whether the transaction, whether they are classed as connected or not. So we know that, if it is a connected party transaction, we need to make sure that things are commercial. We need to have the evidence for it, because otherwise, it may be that we get into a situation with unauthorised payments. And so some sort of examples of where more care is needed. The first one I have here is where a company owns premises which have been independently valued as £400,000 and a SIP purchases them for £500,000. Now, if that was an unconnected pension scheme buying it, you'd think that's fantastic. The company's just made a bit more money. They've sold it above market value. If somebody was willing to pay for that, you'd argue what market value is. It's what the market's willing to pay. If somebody wants to pay a bit more for it than the surveyor says, then fantastic, that would be fine. But of course, when they're connected, it's not as simple as that, because that would be deemed as value shifting. So if we know the value is only 400,000 and a connected party SIP wants to buy it for £500,000, effectively you've moved £100,000 out of the pension to the company. That's value shifting. That £100,000 would be an unauthorised payment. We can also have unauthorised payments in both directions. It's both over and underpayment. So for example, if the company pays rent above the commercial level, so above the level that the surveyor said is appropriate for that property. Now you may think that actually the pension scheme is benefiting from that because there's more money going into the pension. Boosting pension funds, is that going to be against pension rules? Well, the answer is yes, you still have issues with it. From the company's point of view, the rent going in is tax deductible. Like pension contributions are also tax deductible. But it doesn't count towards the annual allowance for the members, and it doesn't bring protection for the members. So that can also be an unauthorised payment as well, because obviously if the company is claiming it, it's not at a commercial level, then there's issues with that as well. So that doesn't work either. And then the third one here, which is really sort of coming on to what's the most relevant at the moment with the pandemic and circumstances that we're seeing, is when companies stop paying rent. Now, potentially, if a connected party, so a connected company that's connected to the pension scheme member, stops paying rent, then that can be viewed as a benefit in kind for the member, because the member's company is having the use of those premises rent-free if they stop paying rent, and that in itself can be an unauthorised payment. What's important to note here, though, I'll talk a little bit more about this, is that the fact they stop paying rent immediately doesn't give rise to an unauthorised payment. The important thing here is that it has to be pursued on a commercial basis. So, as we all know, at the moment there's a lot of businesses that are struggling. Many businesses are struggling to pay the rent, and we do have situations with pension schemes holding property which have unconnected party tenants. It's just as true for them as it is for the connected party tenants as well. With unconnected party tenants, that's not going to lead to an unauthorised payment because there's no benefit to the member of that happening. And you would pursue that on a commercial basis. With connected party transactions, if there's any rent holidays or anything to be agreed, we would normally, normal circumstances, we would have to have evidence that that was commercial. And what we would require normally would be an accountant's letter or advice from the company accountants, basically addressed to the trustees of the pension scheme from the company that's the tenant of the pension scheme, basically explaining why they need the reduced rent and the commercial reasons for that. So we would be sort of stressing the high risk to the SIP of the loss of the tenant if the full rental needs to be continued, and the potential failure of the tenant's business. So the accountant would need to provide evidence for a rent holiday to be agreed, and then we'd also need a surveyor who would look at that accountant's letter and take that into consideration and recommend what they would do, on a commercial basis. Would it be commercial, looking at the whole market, to give that rental holiday or not? How easy it would be for you to find a replacement tenant. So that's the sort of evidence that we would normally need. Now, I'm sure in most circumstances at the moment, if we could obtain the evidence, then there would be a lot of circumstances that would agree with it. Yes, it's appropriate to have a rental holiday because that is what's happening with a lot of landlords. But the issue we have, or we've certainly had recently, is the fact we can't get the evidence because with lockdown, accountants' offices have been closed, surveyors' offices have been closed, people aren't working as normal. So it actually hasn't been possible to get that evidence. And the issue with connected parties is if you don't have the evidence, then it's a commercial arrangement, then it can lead to an unauthorised payment. There's also, from the pension scheme's point of view, there's a possible knock-on effect on repaying borrowing. So, if the pension scheme has borrowed to fund the property purchase, it may be there's other liquid assets in the pension scheme or assets that can be easily liquidised to keep making the repayments on and the mortgage for any borrowing that's taken place. That's not always going to be the case. It might not always be sufficient or easy to or even desirable to, given what's happened in the markets generally, that it would be a good time to liquidate funds in order to repay the borrowing. So it has been possible in some circumstances to get mortgage holidays. Obviously, it's wide with pension schemes, obviously that's been available sort of residential and commercially. It would be down to the member to negotiate that directly with whoever, with the commercial lender that they've got the borrowing with. We have seen where that has been agreed, where we've seen 3 and 6 month holidays being agreed with the lenders. Those holidays have been on the capital element, with the interest still needing to be paid from what we've seen in practice. So what have HMRC said about this? What's happening at the moment? What they put in place to sort of help out? So at the end of March, in their pension schemes newsletter, they announced an easement on the requirement of evidence of commerciality for rental holidays. So I say normally with connected party tenants, we would need that evidence from the surveyor and the accountant that it was commercial to have a rental holiday. HMRC have confirmed that given the current situation, that any rent holidays that have been agreed will not give rise to an authorised payment charge, and we are allowed to agree them. So the trustees of the pension scheme can agree them with the tenants, even if they're connected parties, without having to have independent valuations taking place. So that's good news. That's the easements in place. So it came in March. Initially, it was for 3 months to the end of June. In the June pension schemes newsletter, they have announced that it is now extended until the end of October this year. So that is where we are at the moment. So that is the good news. We don't need the evidence. We can agree rental holidays without there being any unauthorised payments. Question then really is what happens next? It's important to remember it's a rent holiday. It's not written off. The rent is going to be due at some point in the future. It's going to be really important when these agreements come to an end to negotiate a commercial repayment plan. Unless HMRC tells us anything any different, which it's not possible, but I'd be quite surprised at. We are still going to, when this agreement comes to an end, I say October at the moment, we are still going to need evidence of a commercial repayment plan. I'm sure if surveyors are back open, everybody's working a bit more normally, certainly. That won't be too hard to get, because obviously there will be lots of businesses and tenants that will be renegotiating following rental holidays. So we will need to have that evidence, because as long as we put a commercial repayment plan in place and that is followed on a commercial term, then you shouldn't have unauthorised payments. However, obviously, if we don't get that evidence, if rent isn't paid, then unauthorised payments may still arise. And it can sometimes be difficult for people, I think, to kind of prioritise, paying the rent to their pension scheme if their business is in trouble and they have other creditors and other people chasing after them and think, oh, it's only their pension scheme. If it doesn't get the money for a while longer, it doesn't matter, because, it's not a third party that they're dealing with. But you do have to act as if it is a third party. And even though the member is on both sides of it, if it's their company and it's their pension scheme, then they have to think in their head as trustees, as a landlord, what would they do? And they have to act commercially, even when it's only their business that is the tenant. So that's sort of a really key point, because if it's not agreed, if we don't have these commercial repayment plans in place, if we don't deal with the issue, the scheme administrator has a duty to report it to HMRC. It's not like a choice that we have about it. We would, be in trouble with HMRC. We have duties to be fit and proper scheme administrator, that, if we just let it go and keep letting it go, it's not something that's going to happen. We will always talk to the member, talk to you as the advisor, try and get this repayment plan in place. But there will be points in time where, if no action is taken, that we would have a duty to report this to HMRC. That should never come as a surprise to anybody. We'll have conversations, your scheme administrators will be having conversations with you first before it gets to that point of reporting it. But action, it's not something that can be ignored. Action will need to be taken about it once the these easements have fallen away. So, question is, I suppose, is what happens if we do get to that point? If there are unauthorised payments, what are the consequences of reporting an unauthorised payment? Well, we have a number of unauthorised payment charges. First of all, the unauthorised payment charge itself, the basic one, is a flat rate of 40%. We have then a surcharge, which is an additional rate at 15%, and then we have the scheme sanction charge, which can be 15 or 40%. And I'll look at each one of those terms to explain when they're applicable and what they mean. So first one then is we have the unauthorised payment charge, which is a flat rate of 40%. And this is a freestanding charge, which means it can't be offset against any of the losses that the member has, the capacity as a taxpayer. For SIPs, the unauthorised payment charge always falls on the member personally. So when HMRC reported, so when the scheme administrator reported to HMRC, we will also tell the member, but they have to put it on their self-assessment. Tell them we're reporting to HMRC, tell them they need to put it on the self-assessment. If they don't fill in a self-assessment, then they will need to contact HMRC direct in order to pay it. Obviously, we are reporting it to HMRC, so they are going to be aware and know about it, even if the member thinks they're not going to tell them themselves. They will find out about it. For a SAS, it's depending on how the unauthorised payment arises, it may be the sponsoring employer that's liable for it rather than the members. And if we're talking in the context of property and tenants, the tenant company not paying the rent and not having a repayment plan in place, then in those circumstances, if it's the sponsoring employer that is the tenant, then that will be the sponsoring, there will be the sponsoring employer, but the unauthorised payment charge will fall on. I say for a SIP, even if it's a SIP member's company, it will never be the company because it's a personal pension scheme. It's it's only the link as a sponsoring employer that makes it applicable for SAS. There's no such thing with SIP, so it will always be the member personally on a SIP. Potentially, you may also have the unauthorised payment surcharge, which is always 15%. Now, this one is only payable when unauthorised payments in a reference period exceed 25% of the rights under that scheme. So a reference period here, the first reference period will start with the date of the first unauthorised payment in that scheme. And then that will run until either the surcharge threshold of 25% is reached, or 12 months following the first reference date. And then the next period will start on the first unauthorised payment after that. That's probably not that clear to understand, so I've done an example on the next slide, which I think makes it a lot clearer. So the unauthorised payment surcharge then. So here we've got dates and unauthorised payments. So the first unauthorised payment is on the 1st of the 3rd, 2020, 1st of March this year. And so that's when the reference period starts. Here we have an unauthorised payment of £10,000 when the net asset value of the pension fund is £200,000. So the unauthorised payment as a percentage of the fund at that point in time is 5%. And overall, because it's the first unauthorised payment we've had, the cumulative unauthorised payments under that scheme are 5%. So the surcharge will not apply. We then, on the 1st of June, there's another payment, this time £20,000. The fund value hasn't changed. So that is 10% of the scheme at that point in time. And we have a cumulative unauthorised payment total of 15%. We've not hit the surcharge limit, no surcharge. 1st of July, there's another £10,000. Fund value at this point in time is only 180,000, so that works out 10,000 over 180,000. That's 5.56% of the fund. Cumulatively, we're now looking at 20.56% of the fund being used as an authorised payment. We've still not hit the surcharge, but then on the 1st of August, we have another payment, £10,000. Fund value is still £180,000, so we have another 5.56% at that point in time that's used as an unauthorised payment. We then add up the cumulative amount of the unauthorised payments and we get 26.12%. So we've breached the 25% limit. So at this point in time, the surcharge applies, but it doesn't just apply to that payment on the 1st of August. Because we've hit the limit within the same reference period, it affects all of the payments that have gone before it, and the surcharge now applies back on those payments as well. If another unauthorised payment is made later, once that 25% has been breached and we have the surcharge applicable on those payments, it starts a new reference period, and then she would start counting again on that one. So for the first period, from the 1st of March payment to the payment on the 1st of August, which triggered the surcharge, we've got a total of £50,000 of unauthorised payments. So the surcharge on that at 15% would be £7,500. Of course, that is on top of the unauthorised payment charge of £20,000 as well. So we have that extra charge. If we're looking at rent on properties, it's fairly unlikely you're going to be hitting the 25% surcharge, given sort of the you'd have a lot of gearing in pension funds for the pension fund to be below that and your rent coming in to be that high. So it is quite unlikely unless you have some amazing rental yields. But obviously there are other circumstances, other kinds of unauthorised payments that can be made, not just property rental, which it was good to know when the trigger is and how it arises. Finally, we have the scheme sanction charge. Now, the scheme sanction charge, the rate of this, the standard rate of it is 40%. This is payable by the scheme administrator. So the scheme administrator is liable for this charge rather than the member or sponsoring employer. But most scheme rules will allow the scheme administrator to take that charge out of the member's pension fund. So normally, it would come out of the SIP. So it's a 40% charge, but once the member has made the unauthorised payment charge, then once it's actually paid, then a credit is given against it. And so it reduces the scheme sanction charge by the amount of the charge paid, or 25% of the scheme chargeable payments that are tax paid. So it reduces back effectively. If the member has paid the unauthorised payment charge in full, then it'll reduce the scheme sanction charge down to 15%. So normally, you know, when we report to HMRC, if the member could provide evidence that they've paid the payment to HMRC, then, you know, once we'd had that evidence, it means that the scheme sanction charge would only be 15%. So that's the amount we'd withdraw from the fund to pay across to HMRC. So looking at the possible charges then, adding those all together, question is, if you have a £10,000 unauthorised payment, how much is the tax charge going to be? The answer is it depends. Depends on the circumstances. You don't know automatically. So your unauthorised payment charge, you know that's always going to be 40%, so that'll be £4,000. The surcharge might not be applicable, might be nothing. It could be 15%. So in this case, £1,500. Your scheme sanction charge, as long as the unauthorised payment charge has been paid in full, then it's 15%. If it's not, it's 40%. So a couple of different scenarios. So first of all, if we imagine that there's no surcharge and the unauthorised payment charge has been paid by the member, then you will always have you'd have the £4,000 unauthorised payment charge, say paid by the member, no surcharge, scheme sanction charge will be reduced, so the total tax charge will be £5,500, so effectively 55% tax. That's your best case scenario on unauthorised payment charge. Option two, same thing again, the member has paid the unauthorised payment charge of £4,000, but if we have the surcharge applicable of £1,500, say the scheme sanction charge will be reduced to £1,500, so £7,000 if the surcharge was applicable. Your third option, if there was no surcharge, but the member hadn't actually paid that £4,000 at the top, and so the scheme would have to pay 40%. So effectively here, the scheme would pay the £4,000. There would still be £4,000 charge outstanding that HMRC would be chasing the member for. So it looks like it's £8,000, but of course, once the member has paid the £4,000 unauthorised payment charge, when they make that payment, then the scheme sanction charge would be reduced, and so you could potentially get that back. So it could reduce back down to £5,500. And then finally, same scenario again, but if you did have the surcharge was applicable, then you know you're potentially looking at £9,500. But again, once the unauthorised payment charge was paid by the member, it will reduce back down to £7,000. All in all, there can be some pretty hefty tax charges associated with an unauthorised payment. So, you know, generally speaking, it is going to be something you're going to want to avoid doing and avoid charges incurring, which is back to my point right at the start when I talked about types of property in the pension scheme. One of the reasons why the rules technically do allow you to put anything you like in your pension scheme, things like residential property, you wouldn't want to do it because these tax charges are fairly horrendous. In practice, there may be the odd circumstances, in particular hardship, where you may be willing to accept an unauthorised payment charge. So, for example, we have a £10,000 rent bill that's outstanding, which the company is just purely not in any position to pay, and they're just not going to be able to do that. The member is personally liable for this. They could be chased for that £10,000 on a commercial basis, ongoing basis. You know, if it gets to the point, you know, it's being done properly, you know, that could send somebody bankrupt. You know, obviously an absolute last resort. But if somebody if the decision was taken to report this to HMRC, the actual personal liability would drop them the £10,000 down to £4,000, because it would drop because of you know, it would be the 40% of the unauthorised payment. They would be personally liable. So if that's assuming the surcharge is not applicable, the scheme sanction charge would come from the pension fund, which would be, you know, £4,000, or once that £4,000 from the member was paid, would be reduced to £1,500, which obviously, you know, it's coming out of the members' fund, but you know, if at times when they can't access any other money, if they're real times of financial hardship, they may be willing to take that, you know, £1,500 hit from their pension scheme if it reduces their personal liability from £10,000 to £4,000. Obviously, the pension scheme's actually missing out on the £10,000 rent in the first place, but you can see there are circumstances where, you know, it's the least worst option, maybe. In say only extreme circumstances, but yes, it does actually reduce somebody's personal liability. Just going to finish off with a little bit on SAS. So we've talked a lot primarily about SIP. Some of you will also have clients with SAS, I'm sure, many of which will hold property, and really the circumstances and things I've talked about with SIP and property were exactly the same for SAS. But the other thing about SAS is SAS obviously have the abilities to do loan backs to the sponsoring employer, which, you know, many will be in place already prior to the pandemic. They may be facing issues in terms of repayments, which I'll look at in a moment. Others may be considering a loan back because their companies are struggling now, that they have money in their pension fund that they may consider doing a loan back. There are very sort of tight rules on SAS loan backs. There's 5 conditions, 5 key tests that have to be met for a SAS to make a loan back to the sponsoring employer. If these are not met and the loan is made, then it is automatically an unauthorised payment. So you do need to be careful with these tests. So first one is that security must be used against the loan. So the SAS must take security over an asset that's valued at equal or greater value than the value of the loan, including interest. In most circumstances, you probably want that to be commercial property. I mean, a commercial property would be the best form of security, obviously, if it didn't already have mortgage on it, which, you know, obviously there's a lot of circumstances where that's going to be the case. But yes, there does need to be appropriate security. Interest has to be paid on the loan back to the SAS on the average of the base lending rates of the 6 leading high street banks plus 1%. So that's only about 1.1% at the moment. It's pretty low, but yeah, that needs to be paid. The maximum term of the loan is 5 years. The total value of the loan can't be greater than 50% of the net asset value of the scheme. And the repayment terms must be equal instalments of capital and interest paid at least annually. So say there's these key tests that have to be met for a SAS loan back. It is possible with a SAS loan back to do a rollover. So this is postponement or rollover. It can only happen once, but it is possible to roll it over for a further period of 5 years, as long as there's no other changes to the repayment terms. You don't have to redo the tests as well. You have to do it at outset. And obviously that may be of use to people at the moment with companies that are struggling if they have already got loans in place. One of the other easements that HMRC announced in the pension schemes newsletter, similar to with property and connected party tenants and rent holidays, that we don't need the commercial evidence at the moment. They've also said the same for SAS loan backs. So normally we would need to see that, you know, postponement of loans, rollovers loans, you know, that these are commercial as evidence, you know, why we're postponing them. That isn't required at the moment, and again, that's been extended till the end of October. But, you know, it's a temporary easement, and like I said, you know, we do need to, once these easements have fallen away and, you know, these holidays can be put in place, they do need to then start these repayments on commercial terms after that. Final thing then, just on other issues with holding property in pensions, be it SIP or SAS. This isn't related to unauthorised payments, but this is just potential issues, few issues we're having at the moment, mainly involving around getting valuations, how difficult it is to get valuations, or it has been for the last few months on properties. So certain times when you need valuations in pension schemes, benefit crystallisation events, somebody starting taking benefits is the first one. Really with this, if at all possible, we would say you would delay the benefit crystallisation event if there's a property already in a pension scheme and you can't get an up-to-date valuation on it. Now, that's not always going to be possible to delay it. To say if you can, then that would be a preferred course of action, but we accept that's not always possible. But HMRC have given us a bit of guidance on this, so saying that the members should try and obtain an update valuation. But if they can't do so, we have to evidence the fact that they have tried but can't do it. You know, in case of HMRC challenging this in the future, it may be that we would need to revisit the valuation at a point in the future. If we use an older valuation, that we might have to go back and get a new valuation, potentially backdated on it. Similarly with cap drawdown reviews, obviously you can't avoid those, other than if somebody decides to go into flexi access drawdown. You know, we can't avoid those. We will have a historical valuation on file, obviously from previous events. So, you know, we can use that if we have to, but people need to be aware that we may have to revisit the calculations potentially, and redo them. So, you know, there is potential there. It may be a challenge in the future. You know, it's just a bit of an awkward situation. Age 75 is another one. Obviously, it's not taking benefits and benefit amounts, you know, maximums having to be reviewed or anything like that with age 75 tests. For most people, it'll be less of an issue, even if we have to go back and adjust valuations later of how much LTA they've used. It's only going to be an issue where somebody is, you know, is going to be breaching the lifetime allowance. Obviously, most people won't be. They're under the lifetime allowance. It's not going to be a big one. But people that are over, who may have a lifetime allowance tax charge at age 75, we'd always try and get them, really try and get the most up-to-date valuation that we can. And if we do have to base it on an old one, then, you know, we'll need to, you know, make sure that the client is aware that this may have to be revisited in the future once we get a more up-to-date valuation. So just want to be aware of really on those. So this is my final slide. So really key points then. First of all, commerciality, we still need evidence whenever possible, and if for sort of, yeah, wherever it's possible, that is always the preferable option. So there are easements at the moment in terms of rent holidays and SAS loan backs, but when we come out of those easements and we're talking about repayment terms, you know, because these easements are only temporary, then we will need evidence of commerciality in the future. Unauthorised payments in SIP, always full on SIP members. When it comes to things like, you know, rent not being paid, I say we will always have discussions first, and we'll try and do what we can to avoid it becoming an unauthorised payment. So there will be ongoing discussions first, so it shouldn't come as a shock, but, you know, the actions we should be able to take to help avoid these. One final point I'm going to just quickly mention, which isn't on the slides because it's hot off the press, shall we say, at the time when these slides were approved. There is something that came out on the 30th of June as part of the Prime Minister's New Deal about Boris's first steps and strategy to rebuild Britain, which has some proposed changes to planning laws and restrictions. And there's some changes to planning permission requirements to convert vacant commercial properties into residential properties, which come into effect in September. So this includes that a wider range of commercial buildings will be allowed to change to residential use without the need for a planning application. So it wouldn't surprise us if people that have property within commercial properties and pension schemes that may have lost tenants, may be struggling for tenants, may make inquiries either to ourselves, to you as their advisors, about change of use to residential. Because it's going to be easier to do it, it sounds like, from September. I think we just need to be really careful with pension schemes, obviously with conversion of use, because of the tax charges and authorised payment charges that arise from holding residential property in a pension scheme. So when it turns about conversions, essentially the question this is from HMRC's guidance, is, you know, would a person normally live in that dwelling? So at the point in time when the property becomes suitable for use as a dwelling, it will be classed as taxable property. It's normally when works are substantially completed. So it's really important that, you know, property is sold out of a pension scheme before it gets to that point, or otherwise you can have fairly nasty tax charges on it. So, you know, if anybody is considering it, if you get asked by any clients about changes for use, you know, really getting it out of the pension scheme is the earliest available opportunity to avoid any issues with unauthorised payments. But yeah, come and talk to us if you do have any of those situations. But I say just to be aware really that there are some rule changes coming in, which means you might see an increase in those kind of inquiries. Right, but that is all for me for today. Thank you very much for listening. If you do have any questions, then please do send them through. You'll get, if you're listening to the live broadcast of this on the 9th of July, you will be getting some follow-up emails from one of my colleagues. Do send any questions through, and then myself or one of my colleagues will do our best to answer those for you. But thank you very much, and goodbye.